Welcome to Mortgage Matters, your go-to podcast for all things home financing. Whether you're a first-time buyer or looking to refinance, we break down the complexities of the mortgage world to help you make informed decisions. Join us as we explore tips, trends, and strategies to turn your home ownership dreams into reality. Let's dive into today's episode. Hello and welcome. Today, we're diving into the world of adjustable rate mortgages or ARMs, specifically tailored for those who are considering buying a home in Houston. Adjustable rate mortgages can be an attractive option for many home buyers, offering the potential for lower initial interest rates and monthly payments. But like any financial product, ARMs comes with their own set of advantages and risks. If you're thinking about getting an ARM, it's crucial to understand how they work and whether they align with your long-term financial goals. In today's episode, we'll explore the pros and cons of ARMs, when they might make sense, and when you might want to stay clear. Let's get started. So, what exactly is an adjustable rate mortgage, or ARM? At its core, an ARM is a type of home loan where the interest rate isn't fixed for the entire term. Instead, the rate is fixed for an initial period, typically 5, 7, or 10 years, after which it adjusts periodically based on market conditions. This adjustment is determined by an index, along with a margin set by the lender. During that initial fixed rate period, the interest rate on an ARM is usually lower than what you'd get with a fixed rate mortgage, which leads to lower monthly payments. But after this period, the rate can increase or decrease depending on the performance of the chosen index, which directly affects your monthly payments. Let's talk about the pros first. 1. Lower initial interest rates. One of the biggest advantages of an ARM is the lower initial interest rates compared to fixed rate mortgages. This can result in significant savings during the initial years of the loan, making home ownership more affordable up front. 2. Lower initial monthly payments. With a lower initial interest rate, your monthly payments during the fixed rate period are also lower. This can free up cash for other expenses or allow you to qualify for a larger loan amount. And 3rd, flexibility for short-term homeowners. ARMs are particularly beneficial for buyers who don't plan to stay in their home long term. If you anticipate moving or refinancing before the adjustable period begins, you could take advantage of the lower interest rates without worrying about future rate increases. And lastly, potential savings if the rates drop. If interest rates decrease during the adjustable period, your ARM payments could go down as well. This leads to potential savings compared to a fixed rate mortgage. Now we've talked about the pros, but of course, there are cons as well. 1. Uncertainty and the risk of increase. The most significant downside of an ARM is the uncertainty of future interest rate adjustments. If rates rise during the adjustable period, your monthly payments could increase substantially, making budgeting more challenging. 2. Complexity and understanding terms. ARMs are far more complicated than fixed-rate mortgages, with terms and conditions that can be really difficult to understand. It's important to fully grasp how your rate will adjust, including caps on rate increase, before you commit to an ARM. And 3rd, potential for payment shock. After the initial fixed rate period, the interest rate adjustment can lead to what's known as payment shock, a sudden and significant increase in your monthly payment. This can strain your finances if you're not prepared for the adjustment. And 4th, limited appeal for long-term homeowners. For those planning to stay in their home for many years, the potential for rising rates and payment increase makes ARMs less appealing compared to the stability of fixed-rate mortgages. So, when does it make sense to consider an ARM, and when should you avoid it? Let's start with when it does make sense to consider an ARM. First, short-term homeownership plans. If you know you're going to be selling or refinancing your home before the adjustable period begins, an ARM can be a smart choice to take advantage of lower initial payments. The second reason is if you're expecting income growth. If you expect your income to increase significantly in the future, you may be able to handle potential payment increases when the adjustable period ends. A third reason, favorable market conditions. In a declining or stable interest rate environment, an ARM might offer the opportunity to pay less interest over time, compared to locking in a higher fixed rate. And fourthly, investment properties. ARMs can be a great option for investment properties where the owner plans to sell or refinance after a few years. This reduces the risk of long-term rate increase. On the flip side, here are some scenarios where you might want to avoid an ARM. 1. Long-term home ownership plans. If you plan to stay in your home for many years, the risk of rising interest rates makes a fixed-rate mortgage a safer, more predictable option. 2. Tight budgeting needs. If your budget is tight and you need the certainty of fixed payments, potential for payment increase with an ARM could pose significant financial risk. And third reason, market volatility. In an environment where the interest rates are expected to rise, an ARM could lead to higher costs over time, making a fixed-rate mortgage the better choice. Choosing the right mortgage is one of the most important decisions you're going to make as a homeowner, and it's not one you should make alone. That's where First Nation Financial comes in. At First Nation Financial, we understand the complexities of ARMs, and we're here to help you navigate these decisions. Our team of mortgage experts will work with you to evaluate your financial situation. We'll explain the pros and cons of ARMs and help you determine whether this type of mortgage aligns with your goals. We offer a range of mortgage options, including ARMs and fixed-rate loans, tailored to your specific financial goals. Our personalized approach ensures you get the loan that best suits your circumstances, and because the mortgage process can be complicated, especially with an ARM, our team provides clear, step-by-step guidance to help you understand every aspect from initial application all the way until final approval. But our commitment doesn't stop there. We also work with a wide network of lenders to offer you the most competitive rates and terms available. Our goal is to help you maximize the benefits of refinancing while minimizing costs, and our streamlined process makes refinancing as simple and stress-free as possible, so you can focus on what matters most, achieving your financial goals. Adjustable rate mortgages can offer significant benefits, especially for those who plan to stay in their home for a shorter period or anticipate changes in their financial situation. However, they also come with risk that needs to be carefully considered. By understanding the pros and cons of ARMs, you can make an informed decision that aligns with your financial goals and risk tolerance. At First Nation Financial, we're here to provide the guidance and support you need to choose the best mortgage option for your future. If you're ready to explore whether an ARMs is right for you, or if you want to learn more about other mortgage options, we're here to help. Are you ready to take that first step towards securing your fixed rate mortgage? Visit our website, fnfloan.com. If you prefer to speak to a mortgage expert directly, give us a call, 832-955-9255, to get personalized assistance and answers to your questions. Don't wait any longer to make home ownership dream a reality. Contact First Nation Financial today and let's get started. Ready to take the first step towards home ownership? Contact First Nation Financial today to schedule a consultation with one of our experienced professionals. Together, we'll make your dream of owning a home a reality.